Dum dum da dum dum da da dum dum da dum da dum dum da dum dum da dum dum da dum 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 da dum dum da dum dum da dum dum da dum dum da.
Hello folks, this is Dave Lentz. Welcome to our video on the Federal Reserve Bank, interest rates and GDP, gross domestic product, which of course has an effect on the employment level in this country. This video was filmed at various times. The first portion of it, the whiteboard portion of it, was filmed basically back when the unemployment level was more of a concern, and that video was more focused on why the Fed might be concerned about increasing the money supply too quickly because of the inflationary dangers associated with a quick increase in money supply if you were in the elbow area of the aggregate supply curve. This video is going to, as it progresses, is going to shift, and it's going to shift because in 2008, with the financial meltdown that was experienced pretty much with a worldwide recession, if not depression, gave the Fed new powers, and as part of the 2008-2009 operations of the Fed, it engaged in new processes that it was allowed to undertake at that time, namely quantitative easing and targeted asset purchases, amongst other programs that it was allowed to employ, new programs. The focus is now less, for federal operations, is now less on the money supply and more on controlling the federal funds rate for reasons that we'll talk about in the video that follows. I want you to know that the federal government's deficit is financed in part through the operations of the Federal Reserve Bank. When the federal government runs a deficit, or just to finance its operations, if there's a differential in the cash in versus cash out, it goes out into the marketplace and it issues treasury bills, treasury notes, and U.S. Treasury bonds. Now the Fed is restricted in terms of its ability to directly deal with the federal government under those circumstances, but I'm not going to go into how they might get around that. But normally the Federal Reserve Bank engages in what's known as secondary market operations. It buys treasury notes, bills, and bonds primarily from primary dealers, which are often banks. And then we're going to show how that creates the money supply. So we will talk about that. We open up with basically some background information, and I show you basically what I amount to some slides that give you background information that helps folks who really maybe didn't have an economics course to sort of understand the situation. Incidentally, the Federal Reserve Bank, while it does hold a lot of federal treasury bills, notes, and bonds, holds less, at least the last time I saw, it holds in its portfolio a lesser amount of federal debt than foreign governments do. So the Chinese, the Japanese, and various other foreign governments actually own a lot of federal government debt. So in any event, without further ado, here's the video. I hope you find it informative and enjoy.
Yes, unfortunately, this is August the 30th, 2019. As I'm putting the finishing touches on this video, I am not going to be in a position, due to the time constraints of this video, to do any discussion on negative interest rates or deflation. The stock market pulled back significantly last week, and there are some rumblings that the Fed has been too stringent in maintaining interest rates, and we need further cuts. But unfortunately, I'm not going to be able to get into that issue about the possibility of negative interest rates or deflation, which we're getting down there near to zero right now on the rates. And so that's going to have to be a subsequent video. And so I just want to let you know that up front. Okay, enjoy the video.
In all things economic, goods and services are produced and purchased, bought in the economy generally. And the amount of goods and services that are purchased and the price that it's paid are determined by supply and demand. This is fundamental to everything having to do with economics. And as you'll know, this is very important, it's crucial. Doesn't matter whether you're buying cars, food, clothes, real estate, or whatever. Everything depends on supply and demand curves. As prices on the demand side over here on your left, as prices go up, people want to buy less, so the quantity purchased, Q, goes down. As prices go down, people want to bargain, so they buy more, so Q goes up, the quantity purchased goes up. On the supply side, as prices go up, producers want to sell more and they'll produce more, so Q goes up. As prices go down, sellers are less happy, and so they will produce and sell less. So that's very fundamental to everything, and in fact it also affects the supply and demand curve, the aggregate supply and demand curve for the entire economy as well, aggregate supply and aggregate demand. That's the aggregation, the addition of all goods and services in the economy, and aggregate supply is all the goods and services that are produced in the economy. Okay, this is a simple demand curve for all goods and services. Each and every one of them has a demand curve like this under most circumstances. As you can see, as prices are high, the Q is less, the quantity is less. As you go out here, there's more quantity. As prices go down, there's more quantity out here that's being bought and sold. That's why a demand curve is downward sloping like that. On the other hand, there's the supply curve. As prices go up, producers are going to supply more, and so as prices go up, there's more quantity down here, and as prices go down, there's less quantity. That's very fundamental. You'll see that in all supply and demand curves. Now, this is very important. Now, where supply and demand cross, this is a supply curve, that's a demand curve. Where they cross is called equilibrium. The equilibrium point determines the quantity that's bought and sold at a certain price, P. There's the quantity bought and sold, and there's the price that it's bought and sold at. All right. Now, when we aggregate supply and demand for all goods and services in the economy, the demand and supply curves look exactly the same as they do for individual shoe, real estate, or whatever. It's just that you add them all together, and the demand curves, the aggregate demand curve just looks like a regular demand curve. Looks something like that, and I denoted AD for aggregate demand. Now, the aggregate supply curve is also, it is in fact upward sloping. Now, it has this little elbow, that is upward sloping right there, this part. But it slopes up steeper over here, and there's a reason for that, and it has to do with full employment, which has to do with, at full employment, you can't produce as much anymore. Even if you try to produce more, you really can't, and then you've got to pay higher and higher wages to try to get other employees to come and leave their current employment and come work for you. So this little elbow here at full employment, FE, is very important, but that's an aggregate supply curve. It is upward sloping even down here, but it just turns steeper right here. There you go. And then we talk about this in fiscal policy. AD is aggregate demand curve. The aggregate demand curve is determined by consumption, the desire for consumer expenditures, Investment, the amount of investment that goes on in the economy. Government spending is G, and X is net exports. We talk about that at length in the fiscal policy video. Now in money supply, we are dealing mostly with the effects that the money supply has on interest rates. And in turn, okay, so money supply affects the level of interest rates, which is like the price or the cost for money. Okay, that's what interest rates are. You can view that as the price or the cost for money, for the use of money. Okay, and in turn, changes in interest rates affect I, the investment in the I in that formula. The C plus I, that I, it affects that. So changes in interest rates affect the I, and that's what we're going to focus on. Now, changes in interest rates may affect other things like consumer spending. I mean, people are less likely to want a mortgage or to buy a car if interest rates are high, for example. But we're just going to focus on investment, the desire of companies to invest in plant and equipment, and things of that nature in the economy. But it could have effects on some of those other elements as well. But for simplicity's sake, we're just going to talk about I in this video, investment. And since monetary policy affects investment, it also affects, very importantly, it has an effect on the amount of inflation, and also monetary policy and the money supply also affects, because it affects interest rates and inflation rates, it has an important effect on foreign exchange rates, the value of the dollar versus foreign currency, which in turn affects exports and imports, the NX in our fiscal formula, the NX. It also may affect the level of foreign investment and a few other things as well. Note that the demand curves for money, we merely replace for the P in our typical demand curve, we replace that with an I because the I is really the price or the cost that we pay for the money. You know, to borrow the money, for example, the interest rate, that you can look at that as the cost for that money. Okay, so instead of a P, we're dealing with I, which is interest rates. Okay, so that being the case, this is a typical demand curve for money. There's money right there. It's downwards. It just looks like any other demand curve, but it has the interest I up there instead of a P. The national, okay. All right. Now, if we increase or decrease demand curves or aggregate demand curves, and we're going to increase or decrease supply curves in these videos, that's all we're doing, because they change the level of equilibrium, which changes the level of Q, which changes the price level or the interest rate level. Q in a lot of these instances ultimately reflects the value of gross domestic product. So the Q value really turns out in the end to be gross domestic product. But that's what we're doing there. And we're going to be shifting demand curves. And here's an example of a shift in a demand curve. On the left, you see a demand curve going from 1 to 2. That's actually reflective of that would be an increase in demand. And the graph on the right is actually, we're not shifting demand curves, we're actually shifting supply curves. In these videos on monetary policy, the Fed sets the level of money supply, so the S here in our case for money supply is going to be a little bit atypical. It's going to have a tendency to be straight up and down or vertical, and we discuss why that is in the video. So it's the supply curve when you're talking about money is not necessarily as typical of normal supply curves. Okay, so basically we are just shifting aggregate demand and aggregate supply curves in these videos to determine GDP. Hello folks, this is Dave Lentz. When I put together originally this video that I'm about to show you on monetary policy, the Fed, interest rates, and GDP, it was more focused on, at that time, back in 2016, when a lot of people thought there was a lot of underemployment in the economy, and they were questioning whether the statistics about the unemployment level were accurate. In other words, the economy had been growing since the 2008 recession/depression, but in some quarters it wasn't growing fast enough, and a lot of folks wanted the Fed to perhaps be a little more aggressive in easing up interest rates and helping the unemployment situation or the underemployment situation. Well, to make a long story short, the focus on that video was more on jobs and why a central bank such as the Fed might be hesitant to expand the money supply in the face of an economy that was at or near full employment, which created this elbow in the aggregate supply curve, which we will explain here in the video. Subsequent events have shown that unlike the inflationary scenario that expanding the money supply might create under a situation where unemployment rates were less than 5%, we have in fact experienced a couple of years, this is 2019 now, of very, very low inflation, almost no inflation at all, despite the fact that the Fed, since 2008 and the financial crisis, then greatly expanded its balance sheet through a process called quantitative easing. And its balance sheet expanded from like 900 billion to a little over 4 trillion, quite an expansion. All of this, to a lot of more traditional economists like myself, would translate into an incredibly inflationary, high risk of inflation environment. But we haven't seen that, and there must be a reason for that. Why? Not only do we not have an inflationary environment, we're looking at a situation as we stand here today where we're perilously close to 0% interest rates, and having negative interest rates is not unfathomable in terms of being a possibility. So this video here is going to discuss some of the reasons, number one, why we haven't had inflation, and we're also going to focus on the fact that the Fed has shifted its focus from the money supply to a more direct approach to controlling interest rates, namely through its influence on the federal funds rate, which it can only influence, but which it can effectively control through this thing called the interest on excess reserves mechanism that has been allowed since 2008. But the one point I want to make here up front is don't get confused in the video. For the sake of brevity in the video, a lot of times I talk about certain actions expanding the money supply, when in fact all they do is expand the monetary base. Now, in order to get to the money supply, you have to take the monetary base, which the Fed has control over, times the money multiplier, and that gives you the quantity of money out there, the money supply in the economy. The point that I'm trying to make is the Fed controls a major component, which is the monetary base, but the money supply is influenced by whether banks are willing to loan excess reserves, for example. If they don't, it doesn't get out into the money supply. And the amount of cash that people take out of the ATM and put in their pocket and don't use. We're going to discuss also the important notion of velocity and why that may have an effect on the lack of inflation we're experiencing right now. But anyway, the Fed does not have total control of monetary policy. When I talk about increasing the money supply in a lot of instances in this video, I'm actually talking about the monetary base, because the additional step of whether banks will actually lend that money has not yet been taken into account. but maybe we'll be able to explain some of that in this video. So I wanted to make that point up front. The other point I wanted to make is also we will talk in this video, or if what you should be aware of is that changing technology may make it so that it actually takes fewer people to produce the same amount of output. If that's the case, what actually is full employment, this all may shift the aggregate supply curve. It may shift the location of that elbow that we talked about, which basically provides the intersection between fiscal policy and monetary policy. Immigration may have something to do with that. The fact that prices are made sticky because of the internet and the availability of global alternatives makes prices sticky may have another effect on the control or the lack of inflation that we've seen in the environment. But in any event, hopefully we'll get to all that in this video. We're going to try to, and so here's the video.
Dum dum da dum dum da da dum dum da dum da dum dum da dum dum da dum dum da dum 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 da 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 dum 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 da 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 dum 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 dum.
Okay, folks, welcome to reasonandbalance.com. Thank you for joining us. We're going to go on with our discussion of monetary policy. We discussed fiscal policy last time. In the time allotted, we've got a lot of ground to cover. So without further ado, let's get going. Last time we discussed fiscal policy. We made the point that there are basically three main elements that are going to affect the level of economic activity in the United States, and that affects jobs and full employment. Fiscal policy, which is set by the House of Representatives, the Senate, and the President, and they have to agree on a budget. And they set the tax code and government spending, the all-important government spending. And the tax, not to minimize the tax code for sure. The second element of that is what we're going to talk about today is monetary policy, the Fed, which is the Federal Reserve Board, and more particularly, the Federal Reserve Board and its Open Market Committee. They are the governing body of the Federal Reserve Bank, which is the central bank of the United States. And then we also said the global factors also affect the level of economic activity in the United States, particularly NX, which is exports minus imports. That's net exports, currency exchange rates, which also affect exports and imports, and foreign investment, and a few other factors. Okay, all right, so moving right along. Talking about monetary policy. The Fed is supposed to be independent, removed from the political tug of war that goes on. And the idea, one of the main reasons for that is it restricts the ability of government to inflate dollars to pay for huge government deficits. That's just one advantage of having an independent Fed. They're trying to make monetary policy so that it's not a political football. It's supposed to, the supply of money is supposed to have some rational relation to a healthy level of economic activity. We're going to get to the issue of full employment in 1 minute. Well, let's talk briefly about that. The goal of the Federal Reserve Board is threefold basically. It's to maximize a sustainable level of employment. It's also, the Federal Reserve in setting monetary policy is also supposed to stabilize prices so that we don't have a lot of inflation, and it's supposed to moderate long-term interest rates. And we're going to see that the goal of maximum sustainable employment and fighting inflation are a little bit self-contradictory, and therein lies the tug of war that we're going to discuss at length today. Okay, so that's where we are. The Fed is, like I said, it's relatively independent. Its board of governors are nominated by the president, approved by the Senate, so you see there is a little bit of a political connection there. My understanding is that the Fed basically it's owned by its member banks, which is basically all your banks in your local community. There are a few exceptions that are under a slightly different banking system. But the banks in your region, your local community banks, and even some of the more national and international banks with more of a national presence are member banks of the Fed. And there are several regions, and my understanding, I'll have to double check, but I think you may want to check me on this, but I think the Fed, the member banks have to make an investment with the Fed. You have to, the Fed is allowed to make, I believe it's a small profit, few percentage points. I think it might be 6, but anything over that goes back to the federal government. Okay, so that's my understanding. Let's see. What else do we need to discuss? Okay, in setting monetary policy of the Fed, they have 5 tools. The reserve requirement, the discount rate, the federal funds rate, the open market operations, and the auction facility. We're not going to really talk about the auction facility today. It really has to do with auctioning off the ability to get reserves with the Fed. So it's related to this reserve requirement. Banks, in order to make sure that the banking system is liquid and safe, all banks have to maintain a deposit, a reserve deposit with the Federal Reserve Bank. Okay, that's called the reserve requirement. The higher those reserves are, the less money the member banks, your local bank has to lend out, and that means they can make less profit if reserve requirements are higher. So if reserve requirements are higher, there's less money to lend, and that makes the money supply go down. So as reserve requirements go up, money supply goes down. As reserve requirements go down, money supply goes up because the local banks have more money. Okay, I am going to go ahead and show you a little bit how the Fed creates or adds to the monetary base, not necessarily the money supply, but adds to the monetary base. As we will see, before money gets into the money supply, it has to first be created in the monetary base, which the Fed has control over. And then depending on reserve requirements, which the Fed also has control over, and depending on how much of their excess reserves banks decide to lend to the public, and the public's willingness to hold cash in their pocket, those factors also have an effect on the actual money supply in the end. But to create the monetary base to begin with, this is how the Fed goes about doing that. And it's pretty much, they can do it pretty much out of thin air. In other words, the Fed can control the size of its balance sheet pretty much out of nothing. Let's take an extremely hypothetical example. The Fed starts out with, up here at the top, with no money, no assets. Let's just assume that that's the case. And we've got a commercial bank down here who just so happens to own $1 million, a $1 million T-bill issued by the United States Treasury Department. Well, a T-bill is basically a bond of very short term, probably 90 days maturity. Anyway, what happens is the commercial bank sells it to the Fed. Now the Fed doesn't give the doesn't have to give the bank anything for that Treasury bill. What it does is it creates a bookkeeping entry basically saying you have $1 million, Mr. Bank, in reserves. Now let's just assume that that meets all that this bank is. Let's assume that the required reserve requirement, the funds that the bank has to set aside and park permanently at the Federal Reserve that they can't lend against. Let's assume that they've met the required reserve requirement and all those excess reserves are in fact lendable to third parties, to real estate developers, to companies, to whoever needs to loan. That bank can write checks against the Federal Reserve account that it has for that $1 million to create loans to people. So basically that's how that money gets out into the money supply, but the bank has to make the decision to loan out that $1 million in excess reserves. So, basically the result is that the Fed's balance sheet has gone up to $1 million in assets and $1 million in liabilities. The reserves are liabilities as far as the Fed is concerned. And the commercial bank has, as an asset, reserves of $1 million that's just like basically cash. It's like their checking account basically at that point over here. But that's sort of how the Fed expands the monetary base from which the money supply springs if certain things happen. Discount rates. Okay, the discount. The Fed will actually loan money to member banks to borrow money to meet reserve requirements. That's the discount rate they send. The federal funds rate is a rate that the Fed has, through technical means, some control over. That's the rate that banks, member banks, lend money to each other so that they can meet reserve requirements. The Fed pretty much sets that too, and that's the federal funds rate. Okay, so as all these things, the reserve requirement, the discount rate, and the federal funds rate, they're like a seesaw with a money supply. Think of a seesaw. As those reserve requirements go up, as the discount rate goes up, as the federal funds rate goes up, the money supply goes down. That's the nation's money, the amount of money out there in the economy for us to transact business with. That's what MS is. All right. If the reserve requirement or the discount rate or the federal funds rate goes down, the money supply goes up.
Okay, I want to interject right here. There's a distinction between the monetary base and the money supply. I talk about certain actions regarding the discount rate and the federal funds rate, etc., as having an effect on the money supply. That may or may not be true depending on certain other factors, which I'm going to talk about later in this video. So I wanted to mention that. Also, just to let you know, the Fed has shifted its focus to fighting inflation through control of the federal funds rate as its primary source of emphasis, rather than worried about the money supply, which normally only has an effect in the long run. In the short run, it's more concerned about interest rates, inflation, and it handles that concern through manipulation of the target range for the federal funds rate, which is the rate commercial banks charge each other to meet reserve requirements. So while open market operations are clearly still important, the focus on the federal funds rate is now sort of el primo in terms of importance, in terms of the way the Fed conducts its operations.
So everybody wants more money. The average person and the average business wants more money out there so the banks will be easier to get money from for loans so that people can transact more business, buy more houses, buy more cars, and everything. So everybody likes a big money supply. But we're going to see here in a second how that can be dangerous. All right. Okay, so these are the tools, and then probably the most important perhaps is the open market operations, set by the Federal Open Market Committee, FOMC. All right, the Open Market Committee, basically this is, let's basically just remember this. If the Federal Open Market Committee decides that they're going to buy U.S. Treasuries, that's bonds, notes, and treasury bills issued by the federal government, Uncle Sam. If it goes out and buys those in the open market, that has a tendency to increase the money supply. So if the Fed buys treasuries, US government treasuries issued by the federal government, that increases the money supply. If it goes out there and sells treasuries, that decreases the money supply. And here again, most of these transactions occur with what are known as primary dealers. And these are often, these transactions normally take place with commercial banks. They're really the other party. And again, it has to do with their ability to meet reserve requirements and how much money they have to lend and things of that nature. So if the Fed buys, it increases the money supply. If it sells treasuries, we're talking about bills, notes, and bonds issued by the federal government, Uncle Sam, that if it sells those securities, that has a tendency to decrease the money supply. Okay. All right.
Okay, at this point, I need to emphasize, or maybe re-emphasize is a better word. Since 2008 and the financial crisis that almost put us into a worldwide depression, the Fed was given certain emergency powers, and it very dramatically changed the way it did business. I think I've already said that the size of its balance sheet went from under $1 trillion, somewhere around 900 billion, to over 4 trillion. And that obviously has some implications for the money supply. But let me make a couple observations here. The statements that you've just heard about increasing the money supply are they're largely true, but there's a big caveat, and here's the caveat. The central bank, the Federal Reserve, it has control over creating this thing called the monetary base, and when it purchases and sells treasuries like I described there, that affects the monetary base. Doing things that basically increase the size of reserves basically are going to have effect on a monetary base, but the monetary base is not the same thing as the money supply. In order for the money supply to be affected, the money basically has to get out. The banks, if they have excess reserves at the Fed, they have to go out there and actually make the loans. This is all dependent to a certain extent on the reserve requirements, the reserve ratio that the Fed would impose. And we're going to talk about these very important new tools implemented subsequent to 2008 called the interest rate on excess reserves. The Fed now can pay interest to banks on excess reserves, and the overnight reverse repo rate. Those are two incredibly important tools that are now that the Fed now utilizes. And one of the reasons why they're so important is that the Fed can now control, even if it expands its balance sheet, it's better able to have some control over whether that money that's sitting in excess reserves is actually going to make it out into the economy. But I'll get to that in a minute. But anyway, so that's just one thing. So we've got basically when this money's been created in the monetary base, the question whether it's going to make it into the money supply. The Fed controls the size of the monetary base. The Fed also has some effect of whether it gets out into the actual stream of commerce, into the money supply by control over the required reserve ratio. And but there's two other factors that are very important in this, whether it gets into the economy and it actually circulates the money from the monetary base, and that is if people pull money out of ATM machines, their willingness to basically sit on the cash and hold it, that affects it. And the other thing is whether banks actually end up lending out their excess reserves sitting at the Fed. And this has a lot to do with the interest rate on excess reserves, which we're going to talk about, and the reverse repo rate, which we're also going to talk about. So anyway, so just want to because I say money gets into the money supply. In the old days, that was probably very true. It would just get out there right away like that. But today, it's a little bit trickier than that. Okay, and the other thing I need to mention here is that since 2008, the Fed has new tools. They did this thing, these two major programs. One was called quantitative easing, where they went and targeted asset purchases. And basically what that boils down to is the Fed, in order to basically stimulate certain sections of the economy and to sort of, without getting into too technical an explanation, to try to somehow manipulate and the yield curve a little bit, started buying longer term securities in areas that they didn't typically buy securities in, namely mortgage-backed securities, which will have a tendency to be 20 to 30 years in term. That's longer than what the Fed typically would purchase. Traditionally, the Fed traditionally bought shorter term treasury bills and restricted themselves to basically treasury type securities. Now they're buying mortgage-backed securities and even commercial paper. Commercial paper is short-term loans that high quality corporations would issue to help finance their operations. So the Fed, in the emergency circumstances of 2008, started doing a lot of things that didn't ordinarily do. The other thing is that the Fed has made a much more concerted effort to be transparent in where they intend to go with interest rates. This is to help promote stability and confidence in the system, because it's open and apparent, and people don't have to speculate so much on what the Fed's going to do in the future. Now, the Fed may have to reverse course. I mean, just because they say they intend to do something, that doesn't mean they're going to do it. But at least if their heart's in the right place, and these men are supposed to be fairly trustworthy. As a matter of fact, a whole lot depends on the credibility of the Federal Reserve, a whole lot. This forward guidance is an important tool. They basically make public statements about where they intend to go with interest rates that they haven't done in the past. Like I said, their focus also in the short term is more on controlling interest rates and inflation, controlling the federal funds rate, than the money supply. The money supply is more important in determining long-term inflation and long-term economic health. But in the short term, the Fed is now more concerned about controlling the federal funds rate, which is now a target range, and fighting inflation. And lest I forget to say it, some of these programs that were promulgated in 2008, 2009, pursuant to give the Fed emergency powers, some of those programs have expired and terminated. I'm not going to go through and say which ones are still in effect or which ones aren't, but some of these emergency powers the Fed no longer participates in.
Now, how's all this stuff related? All right. Okay. We learned last time that gross domestic product, that's the health of the economy, all the goods and services produced by the American economy. If GDP is at that place where aggregate demand, AD means aggregate demand, where aggregate demand equals aggregate supply. And we discussed basically that, like all economic activity that exists in the world, that supply and demand curves exist out there for virtually every type of transaction or every economic situation. And demand curves are downward sloping. As prices go up, there's less demand for goods and services. As prices go down, there's more demand for goods and services. Q is quantity, P is prices here. So if this could be for socks, it could be for shoes, it could be for computers. As prices go down, there's more demand for it. On the other side, on supply situation, normally as prices go up, producers want to produce more because they can make more profit probably. And as prices go down, they want to produce less. So, you know, technically a supply curve goes like that too. I've got it drawn slightly different here for another purpose that I'm going to get to in a minute. But basically, you can make this is a demand curve for any demand. You can make this the aggregate demand curve if you want it. Okay, so that's the aggregate demand curve. And this supply curve right here is eventually going to be the aggregate supply curve. And we'll notice this little elbow right here that starts right about here. And that just happens to be, and we'll get to it in a moment, at full employment. Okay, and as a matter of fact, let's relate to that right now. Okay, we learned from our discussion of fiscal policy, and we did a video on this, that aggregate demand, AD, equals consumer spending, C, plus investment spending, plus government spending, plus net exports minus imports. So that's a very important formula. Now where AD meets AS, this could be here. I'll tell you what. Let's not get there yet. I'm taking it right to the end, and I don't want to do that. Let's suppose, let's put the elbow out here. If this is AD, and this is aggregate supply for the entire nation, that's the aggregate supply of all goods and services, and that's the aggregate demand for goods and services, all goods and services. This is where GDP would be, right here. Okay, so that's how that works. That's what I mean by AD equals AS. It's right here. Okay, and all this would happen to be also. Let's move this. Okay, so this would happen. That's where the prices would be, and this is where the level of GDP would be, right here. And this is in dollars now. That's the level of it. Now, okay, very important point. That's demand now, and there's supply. Now, there's a very important factoid in supply, and we discussed it in fiscal policy. It's this elbow right here. Because this area right here, what we said, that basically, in our discussion of fiscal policy, the economists think that something at or slightly below 5% unemployment is actually full employment. And the reason for that is the idea that some people are just coming or graduating from school, haven't found jobs. Some people have voluntarily left jobs. They may want to be a stay-at-home mom. They may want to just take a rest. They may want to, or they just want to go out and look for a different job. But there's always going to be a certain level of unemployment that you can't get rid of. And they come up with right now something 5% or slightly less than that. And that happens to be a very relevant figure. Now this is March the 18th. 2 days ago, the Fed increased one of these rates. I think they increased the federal funds rate. And what does that do? They increase the federal funds rate, that decreases the money supply. So that's what happened a couple days ago. All right. So let's see. All right. Well, anyway, since full employment is at 5%, here's the economic concept. Suppliers at that point at full employment may want to produce more. They may want to produce more even because they know they can get bigger prices for it, but the fact of the matter is, if everybody is fully employed and factories are going at full production, existing factories are going at full production, they can't produce anymore. And if they do try to produce more, what will happen is they'll have to go out and get additional workers, and who already have jobs. They're going to have to bid higher prices to get the new workers. There's going to be high demand out there for other plant equipment, and they're going to have to acquiring these assets and that personnel for higher and higher prices. So what happens is you can't get further out on the quantity. Q is the quantity. So out here somewhere, this is where the GDP is, I'll put O, because the economy is overheated, and you're going to have, instead of prices being down here, prices are now going to be up here. And this area in here is called inflation. I'll put INF, inflation. So that's the concern. Okay. Okay, let's go back to the demand for money. All right. We see that the demand for money has a curve just like the aggregate demand curve. We are not talking about the aggregate demand curve right now. We're talking about, this is MDC, not AD. Notice up here, these are interest rates instead of prices, and this is still quantity, Q, in dollars. Now we notice that for the demand for money, think of it as like the demand for cash. If interest rates are high and you can invest your money and get a lot of interest earnings off it, you don't want cash so much. So the demand is going to be less if interest rates are higher for use of cash as an asset. So, okay, and so think of it that way, or you can think of it as looking at this as sort of like if you're a borrower. You can sort of look at it that way in the sense that if interest rates are higher out there, you know, the thing of it is you don't want to borrow quite so much than you do if interest rates are lower. And this demand curve is also affected by transactions demand, which again has to do with the level of the economy. And this is going to be how we're going to tie in the money demand curve with AD, aggregate demand. As the economy heats up, there's going to be more and more of a money demand curve. I mean, more and more quantity of money demanded. So I have interest rates right here, just I pulled them out of thin air. They could be any interest rates. As interest rates go down, we can see that the quantity demanded goes out, right? So this is going down. As interest rates go down, you're increasing, for example, as the money supply increases, okay, you're going to push the quantity of money demanded out, which means more money, all right? Now, when the Fed sets the money supply, easing is when the money supply goes up. This is called easing. When the money supply goes down, this is called tightening, okay? Now, when the money supply, the Fed sets the money supply, that's the amount. There's no demand curve. It's a set figure, and that's why that line is vertical, okay? As you ease, you can see you go from underemployment to full employment to overheated, UFO. That's what I've got up there. And if the economy is already overheated, you may want to tighten, the Fed may want to tighten, and go from O to F. You don't want to go to underemployment, so they would probably stop. So they would only do, if they did this, it would be a mistake right here, okay? This would be a mistake, and this would be a mistake, all right? Because theoretically what you want is full employment, because the Fed's goal is not only to see that there are jobs out there, but also not to have inflation. And we're going to see in a second that if they go from here to here, or from here to here, that it's going to be inflationary. I'm going to show you why in 1 second. All right, remember our aggregate demand curve. And let's focus on I for a second. Remember, that is investment spending, all right? This is now the investment demand curve. This is just a demand curve for one of these elements, okay? Just one of them, just the investment side. This is the investment demand curve. At higher interest rates, there's less demand for a company to buy new plant and equipment and to make investments, okay? Just like you're less likely to buy a home or a car at higher interest rates. Okay, but at lower interest rates, you're more likely to buy a car, and businesses are more likely to buy plant and equipment and expand. So, as interest rates go down, we see that there's more and more investment. You go from IU to IF to IO, okay? Now, here's the important effect in how the money supply curve works with aggregate demand. The money supply curve, when you shift the money supply, it has an effect on I. As interest rates go down, it increases investment and shifts the entire curve to the right. As interest rates go up, it makes investment go down, that number becomes less, and that shifts the entire aggregate demand curve to the left. And it also has other effects, but we're just going to focus on I right now. The amount and the money supply is going to have an effect on interest rates, which would affect currency exchange rates, which may affect net exports, net imports, might affect home purchases, auto purchases, which may affect C, and may have something to do with whether the government decides to have deficits or not. So there may be other effects to shifts in the money, or changes in the money supply, but we're just going to focus on investment here. So anyway, let me get over here for a minute. All right. So anyway, so what happens is because there's, like we said, there was a shift in the entire aggregate demand curve, okay, as interest rates go down, that it shifts right, okay, if there's easing, right, because interest rates have gone down, right, what's going to happen is like, this is AD, this is the aggregate demand curve for underemployment, this is full employment, which is basically 5%, and this is overemployment. Let's see what happens. As you can see, if we were back here at aggregate, there's the aggregate supply curve. Here's the elbow in the curve. It's going like this, right? That's aggregate supply, right? Right there. Okay. There's the aggregate supply curve. And these are three aggregate demand curves. If we were back here before, like we've been for how many years, since 2007, 2008, you needed easing. You should have had easing, and they had quantitative easing and all that. They were trying to move the aggregate demand curve this way by doing a lot of quantitative easing to try to get it to full employment. Well, lo and behold, a couple days ago, they must have finally figured, well, we've hit the goal of full employment, and we better watch out of what we do, because we don't want to because if we're right here and we continue easing up on the money, we may end up here, which would put, if this is prices at full employment, these are prices at underemployment, and this is prices overheated, okay? Actually, they probably thought that we were probably somewhere up in here, or that we were headed in that direction. But you see right here, here's the problem. To go from PU to PF in prices and go from here to here, you only have this much of an increase in prices. And you get this much of an increase in GDP. You go GDP, underemployment, GDP, full employment, and then the problem here is you get overheated GDP. And this area right here is very little, but you're getting this huge amount of price increase. And this is exactly what, because this elbow up gets quite steep the further out you are and having too much money out there. Let's see, what else do we need to discuss?
Okay, I am going to put here the slides that I had on the whiteboard in this section of the video. There is another section to this video that talks about using the federal funds to target inflation and interest rates and maintaining stability, which is more in accordance with the way the Fed now operates. That will follow these slides, and then at the end of that I will endeavor, if I can, to put up slides of the diagrams that I use for illustration purposes. So hang on.
Bum bum ba-dum, bum 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 ba-dum. Dum dum da dum dum da da dum dum da dum da dum 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 da 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 dum 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 dum. Bum 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 ba-dum, 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 bum 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 ba-dum. Dum dum da dum dum da dum dum da dum 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 da 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 dum 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 da 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 dum dum dum.
Okay, I'm going to show you some definitions right now for some of the symbols that I use. I'll try to make these available so that you can refer to them if you need to. But pi is inflation. Some of the more important ones you need to know is that little triangle, the delta, that means change. Like if you see a percent sign next to a delta, that means percentage change. Like percentage change, M is the change in the quantity of money, percentage change in the quantity of money. Another important one is percentage change in P, the price level. That's actually inflation also, along with the pi. Pi C is current inflation. If you happen to see something like a pi E, that means expected inflation. And if it was pi T, it would be target inflation. We'll see if we get to those definitions in the videos. PO is potential output, CO is current output, and another one is nominal interest rates, which is I, and then there's the real interest rate, which is R. Now the nominal rate is like if you went out and took out a loan on a car and it said your promissory note was 5%. That's the nominal rate. The real rate is probably something closer to like 3%, maybe, because the nominal rate, the 5% I, has an add-on for inflation, expected inflation. So the real interest rate R plus the expected inflation would give you the nominal rate. So the nominal rate includes the real interest rate, which is adjusted for inflation, and it includes a rate of inflation. So basically R plus pi expected equals I. We'll get to that a little bit later, but anyway, so the nominal rate is the face amount of the line. And when the Fed sets the federal funds rate, they set a nominal rate, but because it includes inflation, something slightly less than the stated federal rate is the real interest rate. That's after you back out inflation. So that's important, I versus R. And of course, GDP is gross domestic product. GDPR is real gross domestic product. Back out inflation. And here's some old friends, just to refresh your memory from doing the aggregate demand and aggregate supply curve on fiscal policy. AE is aggregate expenditures. AD, of course, is aggregate demand. C is consumer spending. I is investment. G is government spending. And X minus M is exports minus imports. So anyway, that's just that. All right, now the one thing, okay, what they had found was that focusing on strictly the money supply, especially in the short term, that if the Fed just focused only on the money supply growth, the growth in the money supply, in making its determinations regarding monetary policy, it made predicting the velocity of money, which we have discovered as a key component in the fight against inflation, that predicting velocity was impossible, and perhaps just as bad, if not worse, it had a tendency to destabilize interest rates, which of course makes planning very impossible. And this gets to the point of why stability is so important. I mean, you want to be stable. The Fed obviously wants to stabilize prices. That's the sort of the crux of the issue. And well, it's one of the things that stabilization of prices is one of the goals that the Federal Reserve seeks to achieve. But if you have stability, what that allows is it lessens risk, overall systemic risk, and which has the benefit of having a tendency to decrease pressure on interest rates. And if interest rates go down or they don't go up, it has a positive effect on aggregate demand, which has a positive effect on the economy. Why is this? Stability allows people to plan. If you're able to plan and you keep pressure to keep interest rates down, it allows businesses to invest. And it also, that helps employment. If you have stable employment, that makes consumers more willing to spend money in the marketplace, and people have smaller rainy day funds. They go out and they spend money, in other words, if there is stability in the system. So this is one reason why the Fed is so concerned about stability and doesn't like to see a lot of wild gyrations from boom to bust in the economy. Okay, so why are we so concerned about inflation, especially when it's as low as it is apparently right now? Well, I think that there's a fear, especially amongst those folks that have been around a little bit longer, that sort of inflation is one of those things that once the genie gets out of the bottle, it's hard to put back in. And if it gets real bad, it becomes politically destabilizing, especially if you look at some of the situations in some of the third world countries where they've got inflation, above 20 or 30%. I remember a time where you could literally go in a store in the late 70s and early 80s, and by the week, the price of groceries would go up, and you had 13% mortgage rates, and car loans were at 17%. And what that ultimately does is that it slows down the economy enormously. So basically inflation is a worry because goods and services become more expensive very quickly in a highly inflationary environment. Wages become less adequate. That means there's upward pressure on wages, which puts upward pressure on prices, which makes it more likely in the end that people are going to have to go out of business. Mortgage rates go up, which suppresses home sales. Car loans the rates go up, fewer cars are sold. And so in essence, inflation is a big concern because ultimately it has the effect of increasing interest rates. And because when you have inflation of 2%, if you have if a bank made you a loan at 1%, but if you take into account inflation of 2%, that means that when the loan is repaid, they're actually making a minus 1%. They're taking really a loss. So when a bank or anybody makes you a loan, they've got to take into account the inflation rate when they set the interest rate. So basically the bottom line is this. As you can see, now I'm not going to parse fine definitions here. Roughly speaking, aggregate expenditures roughly equates to aggregate demand, and I'm trying to translate this consistent with other portions of this lecture. But basically aggregate expenditures, AE, is basically aggregate demand. And as you'll recall from the formula, aggregate demand curve was like C, consumer spending, plus investment, plus government spending, plus net exports, which is X minus M. As interest rates go up, R is the real rate, pi is expected inflation, and I is the nominal interest rate. As all of those go up, it has the effect of depressing, pushing down the value of aggregate expenditures, aggregate demand, which depresses the level of the economy. So it's not good. And I just want to point out down here that roughly actually it's in excess of 80% of the economy is sensitive to interest rate movements. I've got here the G, government spending, is not that sensitive to interest rate movements. And I'm going to have to double check those figures, but obviously the government pays interest on its bonds, but the government borrowing and the actual amount that the government's going to expend on goods and services, I guess I take it from that factoid, is not that dependent on interest rate fluctuations, but clearly there's an interest component to government spending. In any event, but when the federal, like I said, in terms of smoothing out the economy, the Fed's primary tool anymore is a focus on regulating a range for the federal funds rate. And I'm just going to, let me see if I can find this other slide in here, and I wanted to point this out. The real interest rate is basically the interest rate after you back out inflation. Nominal interest rates, which is the face amount of the loan you pay, in this case the federal funds rate, basically has an expected inflation component, which is pi, and it has a real interest rate, which is basically what you're really, whoever the lender is really making on that loan after inflation is taken into account. But you'll notice that the nominal rate, the face amount of the loan, takes into account inflationary expectations. Now, inflationary expectations are very much guesswork about what folks think the inflation is going to be in the future. That is extremely tied to the credibility of the Federal Reserve, and the marketplace basically wants somebody that they think is going to be objective and credible in trying to control inflationary pressures. This goes to the issue of why it is probably important that the Fed maintain independence. It's an argument for that because the assumption being, it may be false, but it's probably true, at least probably that's the opinion here, that if you leave it to politicians, they're going to be less concerned about inflation probably in the short run. They're probably going to be more concerned about jobs, but that would kick in inflationary pressures. But that would have the effect, that might be a short-term solution and would have the effect of building in a lot more inflationary expectations in the future, which would have the effect of increasing interest rates generally, which would have the effect, as time went on, of depressing aggregate demand, which would depress the economy. So that's why we're concerned about inflation. It has an effect on interest rates, and eventually it pushes the economy down and makes us all a little less well off. Okay. Stability is a key objective. The Federal Reserve seeks to stabilize the economy so that it's not expanding too quickly or it's not contracting too quickly. We're trying to keep it stable along a normal path, which is consistent with something called long-run equilibrium. I'm not going to get too much into long-run equilibrium in this video, maybe in some future video, but by and large, there's a path that the economy goes on that is along its long-run equilibrium curve. At that point, its current output is equal to its potential output, and that's assuming the use of existing technology and the normal use of existing resources. In order to stabilize the economy, because as we've said, it allows people to plan, it makes basically decision-making less risky, which has effects on required rates of return and things of that nature. Here I've made a little graphic here to try to illustrate the point. The normal curve is along the black line, where current output equals potential output, CO equals PO. And if the economy is running a little bit faster than that, a little better than that, that has a tendency to push inflation up. And if it's running slower than that, it has a tendency to push inflation down. Okay. Now the Fed engages in terms of managing the economy in inflation targeting. As a rule of thumb, normally the Fed has tried to keep inflation in the United States around 2%. Now that can vary, but that is sort of the rule of thumb inflation target that the Fed typically would like to use more recently anyway. But like I said, if the economy is running a little bit above normal.
Okay, just to make sure we're clear on this, during an expansionary gap period, inflation is likely to rise, and the Fed's response is likely to be to increase interest rates. If you're in a recessionary gap where the economy is cooling below normal, that's likely to put downward pressure on inflation, and the Fed's likely response is to put downward pressure to lower the federal funds rate.
Now, of course, when it sets that range, it sets it at a nominal rate when the Fed does that. But when it sets the nominal rate, which is the face amount of the rate, that already takes into account in there an inflation target. So really what it's really doing is altering the real interest rate, not just the nominal rate. So most key decision making is based on netting out inflation and what the real interest rate is. So when the Fed changes the nominal rate of its targets, it's actually changing the real interest rates. In the fiscal policy video and also in the earlier federal interest rate, the Fed interest rates video that I did previously, we talked a little bit about the aggregate demand curve, which was based on our old friend C plus I plus G plus X minus M. Here, for reasons that I can only speculate, so I don't know for sure, but the AD, the aggregate demand that we referred to in that video, in those videos, we're going to refer to here as aggregate expenditures, AE. There's no real reason for that other than the tendency is to call a slightly different curve right now the dynamic aggregate demand curve. And I'm not really going to get into that in this video, but I think that that's the reason there's a slight distinction in the, or change in the terminology. But don't get confused. Aggregate expenditures is really sort of very much like the AD we talked about in the other video, which is aggregate demand. So anyway, output, which is Y, is equal to aggregate expenditure plus C plus I plus G plus X minus M. That's our old friend. That should be a very recognizable formula. Well, naturally, all of those components, C, I, G, X, and M, all have portions of those accounts that are interest rate sensitive. They're not entirely interest rate sensitive, but portions of them are. And with respect to C and I and X minus M, they are significantly affected by interest rates. So, as the real interest rate goes up, and that happens if the Fed increases the federal funds rate, as the real interest rate goes up, the interest components, interest sensitive components of C, I, and X minus M all go down, making income, or the output, go down itself. So the result is that as the real interest rate goes up, output goes down. As the real interest rate goes down, output goes up. That makes inherent sense. If interest rate goes up, car loans are going to be more expensive, mortgages are going to be more expensive, interest rates that businesses have to borrow monies at to buy new plant and equipment are going to go up, and that makes it less likely. So investment will go down and consumer expenditure will go down. As the real interest rates go up, the dollar becomes more expensive. I mean, more value appreciates here, and that makes exports more expensive overseas. It makes imports less expensive over here. So it even affects trade and drives. If interest rates go up here, it means that X minus M will go down. So in any event, the aggregate expenditure curve, when juxtaposed with real interest rates, as you can see it over here, is a downward sloping curve, much like the old aggregate demand curve we were discussing before, which really they're the same thing here. And as you can see, that if interest rates go from 5% to 8%, it pushes down aggregate expenditures, or in this case output, from, I've got 1.6 trillion to 1.3 trillion. Those are just arbitrary numbers, for example, that I use as examples here. No special association there. And the converse is also true. When aggregate expenditures, when the real interest rate goes down from 8% to 5%, it pushes out output from, it increases output from in my example, 1.3 trillion to 1.6 trillion. 3, 2, 1. Okay, I was sort of hesitant to sort of get into this area, but I'll try to make it as explainable as and understandable as I can. let's talk about the Fed's balance sheet and how that adds to the monetary base. I want to distinguish between the terms monetary base versus quantity of money or money supply. The monetary base is something that the Fed directly controls, and eventually it makes its way into the money supply, but there are other actors that have an effect on that as well. How do we get there? Okay, the Fed engages in open market operations. Traditionally, they buy and sell treasury bills and bonds from banks, primary dealers out there in the market. When they buy a treasury bond, they credit the selling bank's account at the Fed with whatever the purchase price is. Now, that bank then has an account at the Fed that has a certain amount of alleged money, and it will say there's money there, okay? Now, of that bank's deposit at the Fed, some of those are required reserves and some are excess reserves. The required reserves are required to be there by the Fed for safety purposes. So there's required reserves that the bank cannot lend out. There are excess reserves that the bank just leaves at the Fed for whatever reason, okay? And then, of course, the bank also may have some money that they don't keep at the Fed. They may take some of those excess reserves and put them in their own vault, for example. So basically the proceeds from the sale of that treasury bill to the Fed by the commercial bank creates required reserves, which have to be remain at the Fed, excess reserves, which don't have to remain at the Fed, but which can be loaned out eventually, and then residual deposits that the bank may keep or put in its own vault, and they can loan that out naturally. Okay, so anytime, basically, now the reverse of the transaction is if the Fed sells those bonds out in the public or back to the bank, but I don't want to talk about that. I'm talking about expansion of the money supply. When that happens, when the Fed buys treasury bills or any other assets from commercial banks, during the period of quantitative easing, for example, they bought mortgage-backed securities from banks, for example. That expands the money supplies because what happens is that the Fed's balance sheet grew as a result of that acquisition of those treasury bills. Okay, so the balance sheet of the Fed expanded and the monetary base, not the money supply yet, but the monetary base expanded by, if it was a $1 million purchase, by $1 million. Okay. The same thing happens if a bank wants a loan from the Fed at the discount window, a discount loan, that's the name of it, it's called the discount window. If the bank engages in discount loan lending to commercial banks to meet the bank's reserve requirements, required reserve requirements, the Fed charges the bank an interest rate, the discount, which is known as the discount rate, and the Fed rather, has now a promise, the bank's promise, in essence, its promissory note as an asset. A discount loan like that at the discount window also expands the monetary base because that money is now, the loan that was made to the bank is now part of the reserves that count toward the monetary base. Okay. And the same thing happens if the Fed basically buys some foreign denominated bonds, but I don't want to talk about that right now. But so basically, for our purposes, if the Fed in open market operations buys treasury bonds from commercial banks, or if it engages in discount loans, that expands the monetary base. Okay. Now, that monetary base then, and then that makes the Fed's balance sheet bigger. Now, as of 2008, when the Fed was trying to lower interest rates to help us out of that steep financial crisis, they engaged in what was kind of called quantitative easing. Quantitative easing. That's because they started buying securities that they didn't traditionally buy. The Fed did not traditionally buy things like mortgage-backed securities. They started to do that, and they started to buy things like commercial paper. Those transactions all expanded the Fed's balance sheet and expanded the monetary base. Okay, but did it make it into the money supply? Well, now that's the question I'm going to deal with right now. It depends on this thing called the money multiplier. Now the Fed, it sets up those reserve requirements that the banks have to keep at the Fed, and they cannot loan that money out. It has to stay so that the Fed can make sure that there is some liquidity there. Okay, that all affects the required reserve ratio. Okay, so for example, if the Fed says, if you've got deposits of a certain amount, you have to keep at the Fed in required reserves, and I think it also counts, I believe, if it's in their own, if they keep it in their own vault and don't touch it. You have to keep that amount, and you can't loan it out. But you can loan out any excess reserves or any whatever's left over, the deposits that's beyond the reserve requirement. Well, all of that, I'm not going to go through all the technical things, but that money, as it works its way through the lending process to suppliers of goods and services and all that, through the banking system, working out the dynamics of that's too complicated here, but it has a money multiplier effect. In other words, $1 of deposits, $1 of contribution that the Fed creates to the monetary base ends up, in the old days at least, ended up counting in terms of the money supply, the quantity of money in the economy, which is different than the monetary base. If you had $1 of monetary base money created, the actual amount that made it into the economy because of the money multiplier, the quantity of money, if you had 1 in monetary base, you might get 3, 4, 5, or 6 in quantity of money supply, because of the money multiplier. So that's basically the point that I'm making in terms of these formulas right here. Now, I don't want to speak too long about that because I'm not going to have a test at the end of this video, but that tells you what all those numbers mean. Basically, the monetary base, which the Fed controls, times the money multiplier, which the Fed does not totally control, it has some influence on, equals the quantity of money. M is the quantity of money. And this big number right here is the money multiplier, MM. But in essence, in terms of who affects the money multiplier, well, the Fed does in terms of the number RD, the little RD subscript. It affects, because that's the reserve ratio, required reserve ratio. Now the Fed affects that, and I think for some banks, they're not regulated by the Fed may not affect their reserve ratio required. I'm not sure about that. We'll just assume the Fed totally controls it. But I don't think it has, I don't think that necessarily is true on all banks, but I don't know. But anyway, okay. But let's say here, but one of the things that's going to happen is what happens to those excess reserves that the banks leave at the Fed for whatever reason, and they don't loan them out. Because that has happened in big time. And one of the reasons for that may be because of the way interest rates are, the perceived risk that banks perceive in lending out there, maybe the risk of recession, as maybe they just think making loans are too scary right now given where interest rates are. And what happens is there's this very important new tool that the Fed has been given since 2008. The Fed can now pay interest to banks on the funds that banks leave in excess reserves at the Federal Reserve. So excess reserves that are not loaned out by banks but instead parked at the Federal Reserve Bank, excess funds that commercial banks have at the Federal Reserve Bank, which they park there and have not loaned out to the public, earn interest. And that is the interest on excess reserves that the Fed since 2008 can now pay to banks. That instrument is a policy tool that the Fed has used as sort of a means of controlling the federal funds rate. It's a very important tool. But in any event, it also means that banks may not loan the money out because they think it's safer sitting at the Fed and the Fed's paying them some interest, albeit at a very low rate, but it may be better as far as they're concerned than taking the risk of lending it to Joe real estate developer or whoever. And another thing that affects the money supply is whether or not you or I decide to take money out of the ATM machine and put the cash in our pockets. But in any event, those are the effective. So it's the monetary base, which the Fed controls, times the money multiplier, which the Fed has some but not total control over, equals the quantity of money. And commercial banks, whether they loan from those excess reserves, is very important in determining the quantity of money out in circulation. And so because of this link in the amount of excess reserves that have not been loaned out, prior to 2008, the money multiplier was, I think, somewhere around 3, somewhere between 2.5, between 3.5 and 4. And then after 2008, it went down to, money multiplier went down to like 0.5 or something like that, went way down by a factor of 5 or 6 or whatever. And so since then, and because of quantitative easing, where the Federal Reserve's balance sheet has gone from like $900 billion up to $4+ trillion, the Fed has, number one, empirically, there has been less of a link between money supply and inflation than there traditionally has been. And empirically, they've more or less come to the conclusion that focusing on money supply in terms of short-term inflation and in terms of trying to regulate short-term economic stability, that focusing on money supply is not the thing to do, that the thing to do is to focus on interest rates. And they do that primarily through trying to affect and set a range for the federal funds rate, which appears not to have much effect on the Fed's balance sheet, unlike discount loans and unlike open market operations. But in any event, here's the basically the effects, the players in affecting the quantity of money in circulation, the money supply. And you can see that if monetary base goes up, which the Fed controls, then money goes up, the quantity of money. If the required reserve ratio goes up, how much they have to keep at the Fed and not lend out, then the money supply goes down. If banks' excess reserves are held and not loaned out, that means there's less money out there too. And if people pocket cash and don't use it, that has a tendency of taking the money out of circulation and decreasing it as well. The bottom line is that the conclusion that's been drawn is that money supply only has an effect in the long run on inflation. That when it comes to, in the short run, controlling inflation depends on the stability of a concept known as velocity. And the primary tool that the Fed uses to control velocity are interest rates. So basically, in the short run, interest rates are the primary focus of Federal Reserve policy, because the Fed is more concerned, generally speaking, on the short run than in the long run. Not to say that the long run isn't important and that money supply isn't important, but money supply has more of an effect in the long run, less of an effect in the short run. In the short run, velocity has more of an effect. And so in order to control velocity, the Fed focuses on regulating interest rates. Primarily, the federal funds rate has become the primary focus of Federal Reserve Bank operations. Now, let me just say this. Our discussion is going to focus more on the situation here in the United States. The European Central Bank has a slightly different philosophy on its focus on money supply, and what I'm about to talk about may not have much application in those nations that experience hyperinflation. So we're going to focus on the Federal Reserve operations in terms of what they do to manage the economy. Okay, so we're going to, now that we know that the primary focus of the Federal Reserve Bank is the federal funds rate and managing interest rates instead of the money supply, let's see how we get there. Okay, the value of money depends on the supply and demand of money. As the supply of money goes up, the value of money goes down, and that's an inflationary type of situation. So in other words, there's a link between the supply of money and inflation, but like I said, we're going to show that that really has more long-term applications as opposed to in the short term. So let's see how we get there. Gross domestic product, nominal, the nominal gross domestic product, not adjusted for inflation or anything like that, is the money, the aggregate of the money supply times velocity. What is velocity? If I have $1 today, it is, and I can use it to create $4 of GDP, gross domestic product, if I use it 4 times. So velocity is nothing but the number of times the money is churned through the economy in various transactions. So basically, M times V equals the gross domestic product. And I've got that delineated here in terms of GDP equals, that's nominal, GDP nominal equals the money, the money aggregate times velocity. Okay, now beyond that, we're going to take it a step further. Not only does the money supply times velocity equal gross domestic product, think about it, the amount of money times the amount of times it's used out there is going to be what's necessary to support gross domestic product. But gross domestic product can also be broken down into real GDP. Now, real GDP is nothing but a time-adjusted GDP. So we can compare GDP at one point in time, 3 years from now, versus what it is today. So it's basically inflation adjusted. So GDP nominal, today's GDP, if we were to compare it to like the year 2000, we would take the GDP in the year 2000 and multiply it times the change in price level, which is basically takes into account inflation. So basically GDP equals not only M times V, but it also equals gross domestic product times the level of prices, which is, I've got it delineated as GDPR times PL. Okay. I won't bore you with a lot of sophisticated math that I've probably lost the ability to solve for myself. But the bottom line is that if you solve for the adjustment in the changes in value over time, we will see this very important equation that the percentage change in the level of money supply plus the change in the percentage change in level of velocity equals the percentage change level of the price level plus the percentage change level of GDP real, the real GDP. And there it is right there. So what that basically says is that if you take the change in the monetary growth and add the change in the growth in velocity, you get the change in inflation, that equals the change in inflation plus the change in growth. So basically the change in money supply plus the change in velocity is equal to the change in inflation plus the change in GDP. That's that central square, the middle formula. Okay, now, a study of history shows that over time, over the long run, and monetary central bankers and economists make a big distinction between the long run and the short run, a very vital distinction between the long run and the short run. In the long run, an analysis of history shows that velocity doesn't change that much in the long run, but that it does fluctuate quite a bit in the short run. So basically in the long run, in that formula we used, the change in velocity, the percentage delta V is 0. So if we go back to our formula in the long run, the formula from the previous slide, we see that the percentage change of money plus 0, because velocity doesn't change in the long run. The percentage change in money equals the percentage change in the price level and the percentage change in real GDP. So basically we can see that in the long run, only the money changes in the money supply affect inflation and or changes in real gross domestic product. So basically in the long run, only changes in the money supply matter, not changes in velocity. But in the short run, changes in velocity matter a lot. As a matter of fact, they do become the focus of concerns of the Federal Reserve Board. Okay, and let me just say that a change in real gross domestic product depends on a change in technology and or the structure of the economy.
Okay, we need to touch on some of the factors that affect velocity. The biggest determinant of the amount of velocity there is in the money in the economy is the demand for money. If there's a high demand for money, that means less velocity. That's because people want to hold on to their cash if there's high demand for money. Generally speaking, think of it this way, and this is a little bit circular here, but it sort of makes sense. If you have a large amount of inflation, generally what it makes people do is they want to spend their money faster because tomorrow's prices are going to be higher. So they'll want to spend money today. So that lessens the demand of money. And under those circumstances, you're going to have more velocity. That's very much not the case today. We have very low inflation, and apparently we have a much higher demand for money. But let's look at some of the other factors. So it's sort of interesting because inflation is what we're fighting, but it also, you get this snowballing effect. If you've got inflation, it actually contributes to higher velocity, which is, in the short run especially, inflationary. So you can see how that snowball would happen there. High interest rates. Generally, people don't want to hang on to cash if there's high interest rates because they can go out there and invest it and get a higher return on their wealth than if they hold on to cash. So high interest rates reduces the demand for money, but that increases velocity. Now, we don't have high interest rates today. We have low interest rates today. So you can see how that would contribute to lower velocity in the economy right now. When I say now, it's 2019. But it's not just where interest rates are, it's expectations of future interest rates are really key. For example, if you're a bondholder and even no matter how high interest rates are, if you're a bondholder and you hold a long-term bond and you expect in the future for interest rates to go up, you're going to want to sell that bond and go to cash, because anybody that's taken a finance course knows that if you own a long-term bond and future interest rates go up, you're going to lose money if you have to sell that bond because of an unexpected expense or whatever. So if you expect future interest rates to go up, you're going to want to go to cash instead of holding that bond. So that increases the demand for money, which has a tendency to decrease velocity. In other words, the demand for money goes in just the opposite direction the velocity does. Okay, so, but the one thing I want to talk about here, make this very brief point, because it's easy to get confused if you don't sit and think about this, but high rates have a dual effect. If velocity goes up and expectations of inflation go up, this has a tendency to push interest rates up. But as interest rates go up, generally speaking, aggregate demand goes down by more than the effect that velocity has. And so from a more macro perspective, not just talking about velocity, the effect of high rates is often the GDP goes down by more than what the effects of the velocity increase would be. All right, so what else affects velocity? Other factors affecting velocity are this is a big one. If people perceive there to be a lot of risk in the economy, especially if they fear an upcoming recession, if they think that we're going to have a recession where the businesses are about to tank, they're going to want a bigger rainy day fund, which makes their demand for cash great, which would decrease the level of velocity. Naturally, the return on alternatives to cash has an effect on velocity of alternative investments. The liquidity of alternatives also, if certain investments are easily converted to cash, that has an effect on velocity. The general level of the population's income and expense has an effect on velocity. And like I said, new financial products that allow quick shifting between cash and other investments, like I'm talking about basically like money market funds, that has the amount of those has an effect on velocity as well.
Okay, well, how does the Fed set the range of the rates it's going to set for federal funds target range? I can't give you an exact formula, but there's this rule of thumb called the Taylor rule that basically puts the midpoint of that range at a place where the natural real interest rate plus the current inflation rate plus 1/2 of the inflation gap plus 1/2 of the output gap equals the natural rate. And of course, those are all expressed as percentages.
Okay, I'm sorry, I misspoke there. The target rate is equal to the natural real interest rate plus current inflation plus 1/2 the inflation gap plus 1/2 the output gap. Now, one of those components, the natural real interest rate, is a given rate. The Fed has no control over what that rate is. It's given by virtue of market conditions. But basically, it is a short-run equilibrium rate. Like I said, it's a given. The Fed has no control over it. More recently, in the more recent history, people thought it was about 2%, but clearly, this being late August of 2019, severe downward pressure on interest rates, some people are questioning whether that's accurate. Maybe it's closer to zero, who knows? But the Fed doesn't control that rate, it's sort of a given. All right, now being anything that's a natural rate and the long run equilibrium rate, which we're not going to discuss, is also a natural rate. The Fed has no control over it, it's dictated by market conditions. Um, but I thought I would make that point before we moved on.
All right. What is the inflation gap? It's the current inflation rate minus the target inflation rate. That's the inflation gap. What is the output gap? That is, you take the level of current output minus potential output of the economy. That's the output gap. Now, if the current output exceeds the potential output, that's a signal that the economy's overheated a little bit, and that means that the Fed, of course, is going to increase the federal funds rate. If the current inflation is greater than target inflation, again, that's a sign that the inflation needs to be pulled back and the Fed's going to increase the federal funds rate. Naturally, if potential output is under current output, it's the reverse, and federal funds is likely to decrease. If target inflation is greater than current inflation, you would likely see a federal funds decrease also. So there, that is a rule of thumb, and like all rules of thumb, it's not precise. It's been relatively accurate up until a few years ago, and part of the reason for that was determining what the natural real interest rate is. Now, the natural real interest rate is basically that rate which gets you to equilibrium, where current output equals potential output at normal operation levels for the economy. So determining that rate, and the normal rule of thumb for the natural real interest rate was 2%, which in this day and age is probably too high. It's probably closer to zero right now. This is August of 2019. And so that's been one problem with it. But it has been, up to that point, it was fairly accurate, and it's also naturally a good way to help determine which direction rates are going in terms of the target range. So anyway, that's the Taylor rule. Okay, we talked about the Taylor rule. Basically, we said that basically, as it was a rule of thumb, not precise, to set sort of a midpoint of what the Fed wants the federal funds rate to be, which of course is now the major tool that the Fed uses to regulate interest rates. It uses that instead of fixating on the money supply. All right, so remember that the Fed does not have direct control over the federal funds rate, because federal funds are loans made from one bank to another bank so that the borrowing bank can put up sufficient reserve to meet reserve requirements at the Federal Reserve. So when the Fed, the Federal Reserve Bank, seeks to regulate the federal funds rate, it must do so indirectly. But actually, as we will see, even though the regulation is indirect, it's pretty powerful. And the reason it's powerful is because of these two things called the overnight reverse repo rate, ONRRP, and the interest on excess reserves. These are two incredibly important tools the Fed uses to guide the federal funds target range. Okay, now the overnight repo interest rate is the interest rate that the Fed pays to non-bank intermediaries. Now, the Fed normally deals with banks. there are some exceptions, and this is an important one because the parties on the other side that the Fed pays interest to are non-banks. I think they're talking here about like some money market funds would be engaged in these transactions. The interest on excess reserves, the interest the Federal Reserve Bank pays to banks on excess reserves that the banks have on deposit with the Fed, the interest that the Federal Reserve Bank pays to the banks on those excess deposits that rate basically sets the ceiling of the federal funds rate, while the ONRRP, the reverse repo rate, basically sets the floor. So that sets the range, pretty much around some central point, pretty close to the Taylor rule, under most circumstances, but not always. So, there we go. Now these two tools that the Fed uses are incredibly important because they allow, it basically puts the Fed in competition with other potential places where banks can park their money. If the IOER rate is sufficiently high that the banks are comfortable just depositing excess reserves with the Fed and not lending those reserves out to XYZ Corporation for this business purpose, or to mom and dad to buy a car or whatever, then that money stays at the Federal Reserve and it does not get out into the money supply. That may in fact be what we're seeing right now with quantitative easing and a Fed balance sheet which is so huge. The monetary base is huge, but it's not making it out into the money supply because banks apparently are sufficiently happy with the return they're getting on the IOER rate that they're willing to park their money in excess reserves at the Fed. This may be one very important possibility as to why we haven't seen a lot of inflation. Instead of that money sitting in excess reserves making it into the money supply, it's sitting in the Fed's balance sheet basically as excess reserves.
Okay, if you've hung in this long, you're a real trooper, and I'm going to bring this to a close here. Let me just say this. Nowadays, the Fed, because of the size of its balance sheet and a myriad of factors, it is less inclined to use changes in the discount rate and changes in the required reserve ratio, the required reserve requirement, to use those than it has in the past. So those are less important in terms of the importance of the tools that they have to implement their policies. Without question, it focuses more on the federal funds target ranges, and it implements those through its very crucial two newer policy tools, which are the interest on excess reserve tool and the overnight reverse repo rate. Those two mechanisms allow it to have better control over the federal funds rate, and just as importantly, if not more importantly, the Fed can do so without altering its balance sheet very much. So that gives it a very powerful tool to help control what otherwise might be a very, very inflationary thing. Of course, the converse of all of this right now is we have had exceedingly low inflation for a number of years, and critics may argue that the pendulum has swung too much in the other direction, and now we're facing a situation where we're almost at 0%, if not negative interest rates, and maybe even deflation. So maybe the pendulum has swung too much the other direction. If that's the case, that's going to have to be another video, and I can't really get into that now because this video has gone on long enough. So in any event, I want to thank you for hanging in there. You all are real troopers. And if you have any questions or comments, please like us if you think this has been useful. And my name is David Lentz, and I will see you next time. Thanks a lot.